This is Chapter 6, Saving and Investing, discussion number 2, Stocks. What's the riskiest way of investing is buying and selling of stocks. Now, some stocks are riskier than others, but we'll be dealing with that probably with a discussion in class. Now, what companies do is they sell securities, or what's known as stocks, to obtain funds for their company to expand. What they're doing is that they then are selling parts of the company so that other people can own chunks of the company. So stockholders become partial owners of the corporation and they are entitled to dividends. This is essentially the profits of the company that are then shared with the owners. If you bought a stock, you're an owner. Now, stockholders then speculate as to the value of the corporation with the buying and selling of stock. And so, as someone thinks that the company is doing better, they'll be willing to pay more for that stock. If they think the company is doing not as well, then the price will go down. And so that's how people make money buying and selling of stocks in the stock market after the initial sale. After the initial sale, the company has no control for the most part over those stocks. It is out there in the public to be bought and sold. So another way that you can make money other than the dividends is what is known as capital gains. And that simply is that you bought the stock at a particular price. You sold the stock at another price. If you sold it at a higher price, you have a capital gain. You made money on the selling. If you lost money because you sold it at a lower price, that's considered to be a capital loss. So there's two ways to make money: dividends and by capital gains. So, how do you go about buying stocks? Well, they don't let just anyone walk into Wall Street and say, I'd like to buy 10 shares of Walmart. If they had millions of people doing that, it would be even more chaotic than what you see on TV. There is an established practice where there are people who have bought the permission to actually go ahead onto the stock floors that we see on TV and buy and sell stocks for you. They're known as brokers. Now, sometimes that they work independently, but for the most part, they work as part of a company or a brokerage firm. These businesses or corporations are dedicated to offer their services to help you buy the stocks and sell the stocks that you want to do in order to for those business practices. So uh, that's how you're able to do that. Now with the advent of the computer being used in the stock market, there are ways that brokerage firms help you make that connection more directly. Uh, you may have seen some of the companies advertising on TV, so those, but they're still brokerage firms because you still have to go through them. Not just anyone can get into the central computers of Wall Street and commit a trade. Now, when we take a look at where the stock market is, most people look to the New York Stock Exchange, located on Wall Street. This is the preeminent stock exchange probably in the world. This is where all the large corporations that have been created and are established in the United States are being traded. Now, there's another exchange called the American Stock Exchange. This was an exchange created in the early 1900s. A lot of the heavy manufacturing companies of the early 1900s started in the Amex and pretty much are there. Then Amex is kind of a midland place to be. Companies are there mainly because that's where people know to look for them. So the New York Stock Exchange is like the premier area to be. The newest one is called the Nasdaq. Now, the securities dealers, these brokers, had stocks that didn't qualify for the New York Stock Exchange, but were still shares that could be bought and sold and made money off of. So they came up with their own computerized way so that they could let other brokerage firms know that, hey, they were willing to sell shares, they're willing to buy shares. And so this became known as the over-the-counter market because all of them were available and they didn't have to qualify. For example, over-the-counter medicines, you don't have to have a prescription for them. These, you didn't have to have, the stock did not have to qualify for the New York Stock Exchange in order to be bought and sold. So the The National Association of Security Dealers have an automated quotation, and if you take a look at that acronym, you see that it's the National Association of Security Dealers automated quotation. That's where we get the term NASDAQ. Now, these are just places where you can go buy and sell stocks. Now, NASDAQ is just computer terminals, but it's still where they can go. You're not going to go to Sears.com in order to buy and sell shares. Now, the government does get involved in the stock market primarily after the stock market crash of 1929. It had been a business practice of shysters all over American history where people would invent corporations, they'd sell shares in the company, and then it would be a fraudulent where the company either just plain did not exist or was not even close to delivering on its manufacturing promises. And so the government instituted the Securities and Exchange Commission, which was to essentially make sure that everyone was buying and selling with the same information as everyone else, to avoid the insider trading. Also, to make sure that companies were actually doing what they said they were going to be doing by requiring a prospectus business, which is a business plan and some of the company particulars, and to make sure that everyone was dealing honestly. So, but those are not the numbers that we actually look at. The numbers, whenever they say the stock market has gone up or the stock market has gone down, there's no real great way of measuring it. I mean, yeah, computers will do it for us now, but in the early 1900s all the way up through, do we really want to take every single share ever in the corporate world, add up all the values and say, yes, it went up or no, it went down? And can we really know what's going on? Because you don't have to buy and sell shares through Wall Street. I mean, if you have a share and you want to sell it to your neighbor, you can walk over, knock on the door, and say, would you like to buy the share of the company? That's a perfectly legal transaction. However, what was devised in the early 1900s was an idea that if we took some of the really important companies and we only kept track of those important companies, we could have a decent idea of if the overall market is going up or if the overall market is going down. And the first one was called the Dow Jones Industrial Average. And right now, and it started with some railroad companies, but now it's 30 of the largest corporations in the United States that are from various parts or various different industries. And so it's run by the Wall Street Journal, and every once in a while the Wall Street Journal will take a company out because it's no longer that significant, and they'll put another company in, but it's 30 major corporations and they just keep track of those 30 corporations to come up with that magic number that says the Dow Jones was up or the Dow Jones was down. Couple of other indices. First of all, the Standard & Poor's 500 Standard & Poor's is an investment corporation, brokers, and they've come up with a list of 500 companies. Now, all 30 of the Dow Jones are also in the 500 of the Standard & Poor's, and this is giving a broader cross section of the economy, and that's the number. And then again, it doesn't really matter what the number is. What really is important about these indices numbers is if it's going up or if it's going down. And that's what people take a look at, is if the economy is doing better or worse, or if the overall business climate is better or worse. Concludes discussion number 2, stocks, as part of the chapter 6, saving and investing chapter.